So 65 million consumers, so that's 1 out of 5 credit active consumers that are present on Clarity that lenders wouldn't have had insight into. And not just prime and below consumers, right? We have prime and above consumers that also show up on the Clarity database. In fact, 1 out of 4 prime and above consumers are present on the Clarity database. What if lenders don't use alternative data? What is it really costing them?
Yeah, it's twofold. On the one hand side, they might approve bad consumers, right? So not having all the information out there in the market. For example, if somebody shows up in the Clarity database and they're defaulting, if they don't call out to that database, they don't know it, right? Because it's not in the standard bureau data. So if they then proceed and approve that consumer might default with a higher likelihood. And they could have avoided that by just calling out to that data source. So it's bad approvals. And then second, declining good customers, right? It also goes the other way. If you have more information out there in the market, you can make much better decisions on thin filers where you don't have much information on the standard bureau side, right? So talking about cash flow, right? If the consumer consents, you know now everything in the bank account information, what their income is, what their expenses are. You get a much better picture on whether they're worth lending to or not.
Yeah, thin file is always a tricky situation for lenders, right? Thin file could be because of multiple reasons, right? These could be truly emerging consumers. These could be young immigrants. These could be consumers who have used credit in the past, but for some reason stopped using it, right? And for those consumers, again, alternative data proves to be extremely valuable, extremely predictive. You spoke about accidentally approving bad consumers and declining the good consumers, right? Help me translate that into ROI. What does it mean in terms of ROI? Is it just growing the top line, which means more approvals, or protecting the bottom line, which means lowering defaults?
Yeah, it really depends on the financial targets of the company, but in general, it's not good to approve bad customers, right? Because they inherit risk. You will lose up to the credit limit or the assigned line or the loan amount, and that's lost money that can be avoided. On the flip side, if you're not approving good customers, you're missing out on customer lifetime value, right? Some of these customers might be super profitable. So ROI can mean many things, but if you don't look at, for example, the profitability, it could also mean, marketing to the right people, achieving better approval rates, reducing risk, of course, getting less friction overall, and then overall, main thing is also profitability, right?
That makes sense. You made an important point that ROI is not just one metric, and that ROI can show up at multiple stages of the credit life cycle. So 65 million consumers, so that's 1 out of 5 credit active consumers that are present on Clarity that lenders wouldn't have had insight into. And not just prime and below consumers, right? We have prime and above consumers that also show up on the Clarity database. In fact, 1 out of 4 prime and above consumers are present on the Clarity database. So for a lender, let's assume there are 2 consumers that have a 690 Vantage score, so well above prime. But one of those consumers has recently taken out alternative finance loans that have been reported on Clarity. And they've taken out those loans, they're probably defaulting on those loans. Whereas the other 690 consumer has no footprint on the Clarity base. They have not taken out any of those loans. So there's a difference in the risk profile of these 690 consumers. And that's what Clarity brings to the table for lenders. And focusing on Clarity and cash flow, so again, 2 different data assets, how do you see these 2 different data assets solve different parts of the same challenge?
So they are very different from each other, right? So clarity on the one hand side is more used or should be used on the top of the funnel, right? Knocking out consumers that are actually bad. You said it very well. It's the biggest alternative financial database in the market there. 1 in 5 consumers show up there. But if they show up, they usually inherit higher risk. And in particular, if they default on those small dollar loans, that's not a good sign. So when you market to those consumers, you can just knock them out at the top of the funnel. Cash flow information on the other side, what you do there is you give consent to consumer permission data. That information is then categorized and we build insights on top of that. That will then give you more insights on the asset side of a consumer. In the standard bureau information, you have the liability side. And if you combine those two, that's super powerful. That data is usually used more on the bottom of the funnel as a second chance look or just for underwriting overall. And it provides very useful lift. And we've seen lifts across different products, like whether that's personal loans, credit cards, even in the mortgage space, and also across different lenders, whether that's credit unions, fintechs, or bigger banks.
So when lenders are thinking about getting started with alternative data, help me break down into where in the life cycle should they think about getting started?
Yeah. So it starts all with the prospecting side, right? So you can use clarity information for suppression upfront. Acquisitions, you can knock out the wrong consumers. You can use cash flow information for second chance underwriting. On the account management side, it can be used for credit line increase, decrease type of informations. We've actually looked at many different clients, right? We've looked at credit unions. We helped them end-to-end solve their problems. We looked at fintechs. We looked at bigger banks. In general, we try to meet lenders where they are at. And that's our mantra. And we've been very successful there. In particular, if there's clients that are less sophisticated, we try to help them across the entire life cycle. And then clients that are more sophisticated, we might just provide data and they solve the rest themselves. In general, for example, for the cash flow information, we've shown lift of up to 20% on top of the standard bureau data. What's important to notice here is it's not without the bureau data. If you would take out the standard bureau data, that lift would not be there anymore. But in general, we've seen that lift across the credit life cycle and across different verticals. As I said, credit unions, fintechs, regional banks, and also the bigger banks.
So for lenders who are convinced of using alternative data and want to start on that journey, what mindset shift should they make?
Yeah, very good question. I would say don't overcomplicate things. Start simple, right? You don't have to start in the most complicated fashion, right? Instead of building a custom score, you can just use, let's say, cash flow information. You look at their income, you look at some of their expenses, and you just incorporate that into decision trees or something like that. Or you consume a generic score that is built by Experian, for example, right? And you just do simple cuts and then build up from there. I would say many lenders make the mistake that they start too complicated and they think, oh, it takes all this work. But in general, you can start simple. And with the ease of deployment, with the centralized hub, and also with the speed of deployment, you can get this done very quick.
I like that. So yeah, at Experian, we have generic scores that a lender can easily consume. We have multiple sets of attributes for different use cases, for different life cycles, for different industries, which clients can use and build custom models, or we can help them build custom models. So, Julius, for lenders that are looking to start on their alternative data journey, what would you recommend as the first next step?
Yeah, good question. First of all, at Experian, we want to meet lenders where they're at. We understand that different lenders have different complexities. They have different problems to solve for. And so we as Experian, we want to meet those lenders where they are at. Whether we want to do some complex solutioning or whether we want to just help their teams to deploy something, we can do whatever. Whether it's a credit union that wants an end-to-end solution or a fintech that just wants something in particular, or a bigger bank, let's say, that just wants to have raw data, we can do all of it, right? If you want to consume all of our data, all of our attributes, all of our scores, all of that is possible, right? In general, we see ourselves as a centralized data hub for credit data, but also alternative data. And we've worked very hard to make deployments easy.
So again, we have the arsenal. It's a matter of, again, working one-on-one with the lender, specific to their use case, specific to their industry. But that makes sense. Don't overcomplicate things. Start simple. We are here to help you on your journey. This has been a great conversation, Julius. Thank you. Very insightful. Thanks again.
Yeah, thanks, Natasha.